In this video, we are solving the 2025 GCE Principles of Accounts Section B, question 4A. So by the end, you will see exactly how to score full marks. If you're writing your mock exams or your exams, this will be really helpful. Like if you're ready, subscribe for more 2025 solutions and drop 2025 in the comments. Let's dive in. So we'll start by reading the question that we were given here, which is question 4A, section B. The following account balances were extracted from J. Simulea's books at the end of the financial year on 31st December 2023. So these were the details that were given. So the first thing I love to do is reading the additional information very intensively, because additional information, this is where we'll find our adjustments, and our adjustments ultimately affects everything we do. So here, let us go through the additional information. So the first one we have here is depreciation. So depreciation of furniture was at the rate of 10% per annum. The other additional information was allowance for doubtful debts on account receivable was to be maintained at a rate of 5%. At 31st December 2023, salaries of 3,000 were owing and office wages of 2,000 were prepaid. Number 4, office expenses outstanding was 8,000. Number 5, insurance amounting to 2,000 was prepaid. Number 6, goods taken out for private purposes 6,000 but not recorded in the books. So goods were taken out but they were not recorded in the books. Number 7, closing stock was 60,000, and closing stock is always found in the additional information. So what are we being told to prepare? We've been told to prepare the income statement, also known as the trading profit and loss account. We've also been told to prepare the statement of financial position, also known as the balance sheet. So once you prepare the income statement, you will get 19 marks, as long as you don't make any mistake. Once you prepare the statement of financial position, you get 15 marks, as long as you've not made not even one mistake. So in total, you will get 34 marks. So let's start by preparing the income statement, also known as trading profit and loss account. So the first thing I would encourage you to do is always think about the title. Never write the title at the end. You are more likely to forget it once you write it at the end. Just write it before you even draw any tables. Oh yeah, in the exam you don't have to draw, but before you record any transactions, make sure you write your title. So before I write the title, I need to know the name of the person whose books we are preparing. So the name is J. Simulea. So let's now write the title. Okay. The title is J. Simulea's income statement for the year ended 31st December 2023. So when we are preparing the income statement or trading profit and loss account, the first thing we record is what we call sales. So what is the figure for sales? Let's look for it. This figure for sales. The figure for sales is 321,000. So now we record the 321,000, which is this one here. Then once you record sales, the next thing you're going to ask yourself is there sales returns? We need to check the information. Is there sales returns? So let's check. It's okay. Is there sales returns? Yes, there's sales returns. How much is it? 10,000. So what do we do with sales returns? Sales returns is subtracted from the sales. So sales returns will be subtracted from the sales. So 321,000 minus 10,000, you will get 311,000. And what do we call this figure? It's called 10 over. 10 over, or if you don't want to use 10 over, you can say net sales. Yes. So after you write that, you move on to the opening stock, or you can call it opening inventory. So what is the figure for opening inventory? So the figure for opening inventory, we check the information. So what is it? So the figure for opening inventory is 50,000. So let's record 50,000. So 50,000 is this one here. So after you record opening inventory or opening stock, you have to record the purchases. And the purchases can either be recorded in this column or that column, depending on whether it has adjustments or not. So the purchases in this case has adjustments. It has there's purchases returns, and there's also a stock drawing. So we first record the purchases, which is 150,000. Then we record the purchases returns. And what we do with purchases returns is that we subtract purchases returns from the purchases. So how much is the purchases returns in the question? Purchases returns is 5,000. So 5,000. So we're going to subtract the 5,000 from the 150,000, which is the purchases. So 5,000 will be subtracted from 150,000 to get 145,000. So the other thing we have here is a stock drawing. So where did I get the stock drawing? Exactly. So the stock drawing was, I found it under additional information, number 6, or number 6 of the additional information, which is here. Goods taken out for private purposes, 6,000, but not recorded in the books. So goods were taken out, which were worth 6,000, but were not recorded in the books. So purchases are goods bought for resale. They are simply goods. So if goods were removed, and purchases are goods bought for resale, we have to show that some goods were removed by the owner. So how do we show that some goods were removed by the owner? By subtracting the 6,000 from the purchases. So just like I did here, 145,000 minus 6,000 will give you 139,000. So once we finish that, once we're done with purchases, we'll put the figure in this column here. So what we're getting is 139,000. So we're going to add this 139,000 to the 50,000. And what are we getting? 189,000. And what do we call this figure? Total stock available. So once you have total stock available, the next thing you're supposed to do is less closing stock. So what is the closing stock here? Is 60,000. So 60,000 will be subtracted from 189,000 to get the cost of sales, which are 120, which will give you 129,000. So 129,000. Normally you would put the 129,000 in this column here. But because there are adjustments to the cost of sales, what we are going to do is put it in this column, awaiting to be adjusted by other figures. So what adjusts cost of sales is what adjusts cost of sales is what we call warehouse expenses. Warehouse expenses adjust cost of sales. So warehouse expenses, I'm sure you learned that warehouse expenses are added to the cost of sales. They are always added to the cost of sales. Always. So in this case, we had warehouse wages. So we have to add 20,000 to 29,000 and we will get 49,000. So what I wanted you to understand is whenever we have warehouse expenses like warehouse wages, warehouse rent, warehouse light and heat, warehouse whatever, as long as you have warehouse whatever, you have warehouse something, you have to add it to the cost of sales. So once you add, you will get 149,000. So this figure will be subtracted from the turnover or net sales, and what you will get is what we call gross profit, and the figure for gross profit is 162,000. So once you have gotten your gross profit, you have to ask yourself, do we have income? Do we? Yes, we do. We have interest received. If you check the information here, if you check when you have interest received as income, the rest are not income. So we're going to include it under income, interest received. So interest received was 4,000. So this 4,000 will be added to 162,000, which is the gross profit, to get a total income, which is 166,000. So once you have the total income, the next thing you're supposed to do is subtract the expenses. So expenses, we're going to subtract expenses. So what's our first expense? So the best way to collect your expenses is like this. So you're going to be moving from up then down like this, so that you won't miss expenses. Not just getting any random expense, because let's say you start with office expenses, then you move on to rent, then you move on to sales and office wages, you're more likely to forget an expense. But if you move like this, salaries and office wages, then you move down, rent, then you move down, carriage outwards, then you move down, etc. Then you move down, just like that. You keep on moving down. This way, you won't make a mistake. You won't leave out any expense. But if you just get one expense, just mambo jumbo the expenses, you're more likely to forget one or leave out two. Who knows? So the best way you could do it is going down like this. So what's the first expense we have? If we check, we have salaries and office wages. So the column where we're going to put salaries and office wages is dependent on whether or not we have adjustments. So let's check additional information if we have adjustments or not. So let's check. Okay, do we have adjustments? Yes. Number 3. At 31st December 2023, salaries of 3,000 were owing and office wages of 2,000 were prepaid. So we have 2 adjustments concerning salaries and wages. So the first thing you need to know is expenses owing or outstanding or due are added to the expenses. Office expenses owing, outstanding or due are always added. Office owing, outstanding or due are always added, while expenses prepaid or expenses paid in advance are always subtracted. Now let me explain why expenses prepaid or expenses paid in advance are subtracted. Why? Because office expenses prepaid, they relate to the next accounting period, and in the trading profit and loss account or income statement, we only include items that relate to the current accounting period, the accounting period that is going on now, not the previous, no, the one that is following. No, we'll only look at the accounting period that is current, right? That is happening now. So expenses prepaid or paid in advance will be subtracted because they relate to the next accounting period, not now. While office owing or outstanding or due will be added. Why? Because they relate to the current accounting period. Even though they are not paid, but as long as they relate to the current accounting period, they will be recorded in the trading profit and loss account or income statement. So always remember, expenses owing or outstanding or due will be added, while expenses prepaid or paid in advance will be subtracted. So I'll show you. As you can see, office, I'll put the salaries and wages in this column. Then I'll subtract office wages prepaid because they relate to the next accounting period. So 30,000 minus 2,000 will give me 28,000. Then I will add the salaries owing, because expenses owing or outstanding are added. So we'll add 3,000 to 28,000 to get 31,000. So then we move on to the next expense in the same order I showed you. That way you will never miss out, not even one expense. You won't. As long as you do it this way, it's very unlikely you miss out one. So as you can see, I'm moving from salaries, okay, sales, purchases, returns, wages, okay, rent. Rent is an expense. And rent, before we put it in any column, we'll ask ourselves, are there adjustments? So then we'll check under additional information. Can you see any adjustments under rent for rent? I can't see any. So we'll put them. We'll put the rent directly without any adjustments like this. Like this, as you can see, the rent was 15,000. The rent was 15,000 like this. Then move on to the next expense in the same order. So let's see. We'll move down. We have carriage outwards. Let's see if we have any adjustment for carriage outwards, which I doubt. Okay, let's see. Let's check the additional information. I can't see anything relating to carriage outwards. No. So we just record it directly like this. Like this. And it's 7,000. Like that. Then we move on to the next expense. So what's the next expense? Okay. What's the next expense? Allowance for doubtful debts. Allowance for doubtful debts can either be an expense or income, depending on whether it's an increase or decrease. Now, I'll explain what I mean by increase or decrease. So, how did I determine that allowance for doubtful debts is an increase? So, how did I know it's an increase? Because, let me just show you a demonstration. Okay, yeah, there we are. Okay, so allowance for doubtful debts is the same as provision for bad debts. In the income statement or trading profit and loss account, we record the increase or decrease in provision. So in the trading profit and loss account, we only record the increase or decrease in provision. In this case, it was an increase and we record it under expenses. I'll explain how I found out it's an increase. So if it's an increase, you record it under expenses. If it's a decrease, you record it under income. Now, how was the increase calculated? It was calculated as follows. So the first thing you need to do to calculate whether it was an increase or decrease, you first compare the provisions. So in this case, what we'll see, we always have most of the times we'll have the old provision and new provision, unless it's a special situation. But we usually have the old provision and new provision. Now, how do you determine which one is the old provision and which one is the new provision? So the old provision is the one that we are always given in the question. Old provision is the one that we are always given in the question. So the one that we're always given in the question is the old provision. The new provision is the one we will calculate, and it's usually found under additional information. Let me show you what I mean. So where is it? Okay. Yeah, this one, number 2. Allowance for doubtful debts on accounts receivable was to be maintained at the rate of 5%. So accounts receivables are also known as debtors. Accounts receivables are also known as debtors. So what this simply means is that we have to multiply 5% by the amount for debtors or accounts receivables. So what is the amount for debtors or accounts receivables? It is 200,000. So 200,000. So 200,000. We're going to do it like this. Let me show you a demonstration. So 5% multiplied by 200,000, and what you get is 10,000. that is our new provision. So the old provision is the one that we are given in the question, while the new provision is the one that is found under additional information, and we usually calculate it unless it's a special situation. But I've seen a situation where they have already given you the calculated one. So yeah, if you're lucky. So sometimes, most of the times, you have to calculate a new provision for yourself. So this is how you do it. So now, once you have identified the old provision and new provision, how do you determine whether it's an increase or it's a decrease? Because in the trading profit and loss account or income statement, we only record increase in provision or decrease in provision. So how do you know that it is an increase? So an increase, how we're going to ask, for us to know it's an increase, we're going to ask ourselves, is the new provision greater than the old provision? Is the new provision greater than the old provision? If it is, then it is an increase. But if it is lesser than the old provision, then it's a decrease. So if this new provision is greater than this old provision, it is an increase. As you can see, the new provision is greater than the old provision, so meaning that it's an increase. So an increase will be put under expenses, while a decrease will be put under income. So since it's an increase, that's why I am going to put allowance for doubtful debts under expenses. But if it was a decrease, I would have put it under income. It would have been one of the income. But we're going to put it under expenses because the new provision is greater than the old provision. So now, how do I find the actual increase or decrease? So the increase or decrease is the difference. The increase or decrease can be calculated by finding the difference between the old provision and the new provision. So when you find the difference between the old provision and the new provision, you will have your increase or decrease. So difference means subtraction. So if we subtract 10,000 minus 6,000, that is our increase, which is 4,000. If the rows were 10, if the old provision was 10,000 while the new provision was 6,000, we'll still have subtracted 10,000 minus 6,000, and our decrease would have been 4,000. The only difference is that the 4,000 would have gone under income, but because the new provision is greater than the old provision, we'll put it under expenses. I hope that's fine, and if you have any questions, just drop it in the comment section, and as soon as I see it, I will answer the question. So we record it. So this 4,000 is an increase, and we'll record it under expenses in the trading profit and loss account or income statement. So let me show you what I did. Allowance for doubtful debt, 4,000, just like that. That one there. Now so yeah, then we'll continue moving the same order. We've already checked out rent, we already checked out carriage in what, allowance for doubtful debts has already been checked out. Then we move on to printing and stationery. We check this, does this printing and stationery have adjustments? If it has, we put it in a different column, but if it doesn't, we put it directly into the second column, in the third column. So let's see, does printing and stationery have adjustments? No, it doesn't. So we're going to put it directly like this. Printing and stationery will be put directly like this. So then we'll move on to the next expense. Then the next expense is insurance expenses. We're going to ask ourselves, does this insurance expense have adjustments? Does it have? Yes, it does. Adjustment number 5, insurance amounting 2,000 was prepaid. So insurance amounting 2,000 was prepaid. And remember, I said prepaid expenses are subtracted. Why? Because they relate to the next accounting period. So so insurance expenses was 12,000. Then we'll subtract insurance prepaid 2,000. Then we'll get 10,000. Then move on to the next expense. The next expense was office expenses. Office expenses, which was 12,000. We're going to check. Does it have adjustments? Does it have? Let's check it out. Does it have adjustments? Yes, it does. It does. Office expenses outstanding was 8,000. So remember, outstanding expenses are added to the outstanding expenses are added. Why? Because they relate to the current accounting period. So 8,000 will be added. So 8,000 to plus 12,000 will give you 20,000. Then you check if all the expenses are done. Yeah, I think they are done now. The expenses are done. So once you have finished the expenses, the next thing you ask yourself, is there depreciation? So you first finish all the expenses, then you move on to ask yourself, is there depreciation? So yes, there is depreciation. Depreciation of only one fixed asset, which was furniture. Depreciation of furniture was at the rate of 10% per annum. So this simply means we have to multiply 10% multiplied by the original cost of furniture. So what was the cost of furniture? Furniture was costing 20,000. 20,000. So 10% multiplied by 20,000, that will give you 2,000. So the 2,000 will be recorded because depreciation is an expense. So we put 2,000 there. Then we'll add all the expenses. We'll add all of them, and what we'll get is the total expenses, which will be 97,000. This 97,000 will be subtracted from the total income, which is 166,000. Then what will we get? Whatever we get will be our net profit, which is 69,000. Then you're done with the income statement or trading profit and loss account. Then we move on to the statement of financial position, also called balance sheet. So the first thing I said we should do is always first start with the title. Otherwise, if you don't, you are more likely to forget the title completely. And mind you, they give you 1 mark for the title for just writing a title. Sure, why should you not write it? So just write. So J Simulayers balance sheet as at 31st December 2023. If it's a balance sheet, if you are recording a balance sheet, you should write as at. But if it's the trading profit and loss account or income statement, it is for the year ended. Trial balance, it's as at. So what is the first thing we record in the balance sheet or statement of financial position? So we'll start by listing the fixed assets. So when you have one fixed asset, which is furniture, so the cost of furniture was 20,000. So 20,000 here, the cost was 20,000. What was the depreciation? We found it in the trading profit and loss account, also called income statement. It was 2,000. So first find the net book value. Net book value is cost minus depreciation. So 20,000 minus 2,000 will give me 18,000. So once you have that, you can add this 20,000. You get 20,000. Then 2,000. You just write 2,000 here. Then 18,000. Yeah, just write like this. Yeah, you would close the account from here to there, but leave this part because you're still using this figure here. Then move on to current assets. Current assets. The first thing you start with is stock, then debtors, then cash at bank, then cash in hand, then prepaid expenses. But I'm sure we don't have cash at bank or cash in hand, so skip that and then move on to prepaid expenses. So what is the stock given in the question? And in the balance sheet, we only put closing stock. Why do we only put closing stock instead of opening stock? Because in the balance sheet, we only include assets and liabilities at the end of the financial year. It doesn't have to be at the beginning or middle, but at the end of the financial year. That's why we get closing stock, not opening stock. So the closing stock was 60,000, so we put it there. The debtors were 200,000, and debtors have to be adjusted by provision for bad debts or allowance for doubtful debts. They are the same thing. And in the balance sheet, the provision that we put is is the new provision. And I'm sure you remember how I found the new provision. The new provision is usually found under the additional information. And how do you find it? Is that you say the percentage of whatever you've been given, the percentage given in the question multiplied by the debtors. That is your new provision, your new provision. So in this case, the percentage we were given was 5,000. Was 5%. So 5% multiplied by the total debtors, which were 200,000, would give you 10,000. So that's the new provision. So in the balance sheet, we'll put the new provision, while in the trading profit and loss account or income statement, we put the increase or decrease. So you should know the difference. You do not put the same amount for provision for bad debts in the trading profit and loss account and the balance sheet. There are two different figures. Trading profit and loss account, you put the increase or decrease, while the balance sheet, you put the new provision, which was 10,000. So 10,000 will be subtracted from 200,000 to get 190,000. Then you move on to prepaid expenses. We had office wages prepaid, which was 2,000. Insurance prepaid, which was 2,000. Then you add all the current assets to get the total current assets, which was 254,000. Then you move on. You subtract the less current liabilities from the. Then you subtract the current liabilities from the current assets. So what were the current liabilities? We had creditors or accounts payables, which were 120,000. We had salaries owing, expenses owing due or outstanding are current liabilities, while prepaid expenses are current assets. Expenses owing, outstanding, or due are current liabilities. So salaries owing, we'll put it under current liabilities. For fixed expenses outstanding under current liabilities, which is 8,000. Then bank overdraft is the current liability, which we'll put, which is 2,000. Then you add all the current liabilities. Then you get total current then we get total current liabilities. So the figure is 133,000. So this will be subtracted from the total current assets to get 121,000, and this figure is called working capital. So working capital is found by subtracting total current assets minus total current liabilities. That's how you get working capital. So then you move on to the net assets. So how do you get net assets? You add net assets plus the NBV, which is net book value. For you to get the net assets, you add working capital plus the NBV, which is on top here. So the 18,000, this 18,000 here plus the working capital will give you the net assets, which is 139,000. Then you move on to financed by. So financed by. So under financed by, we have capital, which was 90,000. Then to capital, we add net profit. So what was the net profit? 69,000. So 69,000 will be added to 90,000 to get 159,000. Then after that, you're supposed to subtract drawings. So how did I get this figure for drawings? 30,000, when in the question we were given 24. How did I get the 30,000 for drawings when in the question we were given 24,000? So where is it? Here, 24,000. We're given in the question 24,000. How did I get 30,000 at my drawing? If you look under additional information, adjustment number 6, goods taken out for private purposes 6,000 but not recorded in the books. So as long as you see private, goods were taken out for private use or private purposes, it is drawings. So 6,000 is drawings. So this 6,000 will be added to the drawings that were already given in the question, which were 24,000. So 6,000 plus 24,000 will give you 30,000. So give you 30,000. So 30,000 minus 159,000 will give you 129,000. You would normally end here if there were no long-term liabilities, but in this case we had the long-term liabilities. The long-term liability was mortgage. So mortgage, we always add long-term liabilities. That's just how it is. We add long-term liabilities. So mortgage was 10,000. So 10,000 plus 129,000 will give you 139,000, which is the capital employed. So if the capital employed, which is 139,000, is the same as the net assets, if the capital employed is the same as the net assets, so if you notice the capital employed and net assets are the same, so then you know it has balanced and you've gotten the full 34 marks. And I believe it's possible to get the full 34 marks. So net assets and capital employed are the same, so it has balance and you get the full 34 marks. So thank you for listening. Subscribe and turn on the notifications if you want more videos like this. See you